Okay, good morning, good afternoon, good evening, wherever you may be in the world. Thank you very much for joining us. Welcome to the latest in our series of FIP Insider webinars. I'm delighted that more than 1,000 people have joined this series overall since we started running it, and I'm delighted to say that we've got another fantastic turnout today with around 300 people registered. Thank you very much, as ever, for your support. Last week, we looked at the FIP Global Digital Subscription Snapshot with our guests from Solera One and Axel Springer, and we'll be posting a link into the chat box for you to download this report for free if you didn't already do so. And this week's webinar is very much a continuation of the same theme. We're going to be looking at how you can use data to be more effective in your digital subscriptions marketing, with a particular focus on pricing strategies, something that came up in last week's webinar as a question from the audience, and it was definitely an area that viewers wanted to know more about. In a moment, I'll be introducing Martha Williams, my co-host for today's session, and she will introduce you to today's guests from Mather Economics and The Atlantic. Now, to make the most out of today's session, you should also download a copy of our how-to guide to paywalls, which Martha wrote for us recently. A link to download that will be appearing in the chat box. We're publishing that with the support of our partners at Zephyr. If you're looking for a new approach to dynamic paywalls, then please do go and visit their website, which is zephr.com, to learn how they can help you. The forthcoming relaunch of the FIP website is being built around Zephyr technology, so we can certainly recommend it. Now, before I introduce Martha and then she can introduce her guests, let me run through some housekeeping items. Today's session is a Q&A, and we're very keen to hear from as many of you as possible. If you look in your webinar controls at the bottom of the screen here, then you'll find the Q&A button. Go in there and you can submit your questions, and you can also upvote other delegates' questions and make comments on them. There's also a chat box. You can also access that from your webinar controls, and you can use that to chat either privately with myself and the other speakers or with the other attendees, and we'll be keeping an eye on that throughout the event. I recommend that you keep it open because the FIP team will be posting comments and useful links throughout. Now, these events and the work that FIP does to share knowledge across the industry would not be possible without the support of our corporate partners, PressReader, one of the world's largest digital content distribution businesses, and UPM, the world's leading Biofor company. We thank both of them for their support. I'd also like to thank FIP's members for the support that you give to the organization. We wouldn't be able to do any of this without you. In July, we're going to be putting most of our content behind a members-only wall on our website. So if there are those of you who are not members, and if you want to continue making use of the knowledge and insight that we provide, we would encourage you to join. Membership starts from as little as £50 per month, and you can contact me on james@fip.com for more details on how to do that. Tomorrow, you'll all get a post-event email with a link to the slides, a link to download the report, and details of our forthcoming webinars, including some links to sign up for those. Next week, we have a webinar on e-commerce, looking at how InStyle have turned this into a significant revenue stream. And on Thursday, we're joined by senior executives from Dow Jones, another FIP member, to get their take on media pre- and post-crisis. Details of all of these are on the website, www.fip.com, and we will be in the, and of course they'll be in the post-event emails. We look forward very much to seeing you there. Right, that's enough from me. I'm going to hand over to my co-host for today's session. She is a digital media industry author, speaker, and consultant, and has been involved with a wide variety of media businesses and industry associations. I'd like to give a very warm welcome to Martha Williams. Hi, Martha, and over to you.
Hi there. Thanks, James, so much for the introduction, and thank you for your partnership. We're very happy today to present a very topical webinar for you that is all about revenue making during the COVID crisis. Why? Because there are some significant industry incidences right now having to do with advertising and subscriptions that necessitate us to change our strategy. So today we're going to have some great speakers talking about price optimization for our subscriptions in the time of COVID. We're going to have Dr. Matt Lindsay, who's the president of Mather Economics, the preeminent subscriptions company for media. And we'll have Sam Rosen, the SVP for Growth from The Atlantic, speak to us about their case study about price optimization for The Atlantic. And I'm going to dive right into why this is important right now. And that is because there is a huge plummet of advertising, both in the news media industry and, of course, the magazine media industry. And as you can see from this trusted report, the Myers report, a think tank on advertising the media industry, you can see that there is in printed newspapers a 42% drop during the beginning of the crisis from the previous year, and in digital an 8% drop, whereas for magazine advertising, that is consumer print originated advertising, for magazines, it's a 38% drop year over year and a 12% drop for digital. Now, meanwhile, something good is happening, and that is there is a surge in subscriptions, both in print and digital. Here's an example generously given to us to show from Jellyfish, the UK magazine media company. But basically what they're doing is looking at UK magazines and how print subscriptions are surging during lockdown. The time frame we're looking at right now on the screen is March 23rd through 26th of April. And you can see that the largest surge happened when the lockdown started. But it is sustained as time goes on. And these are year-over-year numbers from 2019 to 2020 during that same period. Now, coinciding with this trend is that there is a record-breaking year-over-year magazine content usage pattern. And as you can see, there's gigantic leaps in the amount of year-over-year content consumption in all of these different areas, starting with kids, a 500% increase, home and gardening, 400% increase, women's content, 325%, and news and current affairs, 231%, and so on, year over year from March 23rd to the 26th of April. And coinciding with that is a corollary to the content usage. Now there's a huge uptick in subscriptions in the UK. And of course, this trend is happening all over the world, according to our sources. Basically, here you see gigantic leaps in subscriptions for tech and gaming, 268%, family and home, 259%, women's 177% increase in subscriptions. And this is in the UK once again, but again, we're seeing this all over the world. And the reason this is important is because we can take this trend, look at what's happening with our advertising, and try to maximize our revenues by maximizing subscriptions through optimizing our pricing strategies. So here today, we're going to be talking about that very topic, about maximizing our revenues by optimizing our pricing strategies. And here to talk to you about the science behind these techniques is Matt Lindsay, who, once again, president of Mather Economics. Take it away, Matt.
Great, thank you very much, Martha. I'm going to share just a couple of slides, and while we are doing that, please don't hesitate to jump in with any questions that you may want to have throughout. And I realize that slides are not particularly the purpose of this meeting. It's more of a discussion. So I wanted to please encourage you to jump in and ask any questions through the chat box. So I'm just going to really go through a few slides very quickly. And there's really a couple of primary ideas I'd like to share. One is that there's, in the middle of this COVID-19 crisis, there are some, of course, some major changes to subscription activity occurring in the market, as Martha described. Essentially, the number of subscription sales is growing tremendously. And that's really happening for a number of reasons. One, there's just a lot more visitors to the site. And then second of all, the ones that are being presented with a subscription offer are converting at a much higher rate. So we will be sending this document out to all of you. So please don't, don't hesitate. I'll go through these fairly quickly, but just to give you some ideas of how these things are changing over month, we've updated this report. So the dark blue lines are what happened March over February, and then the light blue is what happened April over March. And we're about to present another update to this, so we'll be happy to share that as well. So again, just a number of metrics here. And again, the core story is that number of subscriptions are up significantly, as well as the overall engagement of sites. So, but there is an interesting analog to what we've seen previously with spikes in demand. And that is that if we look at another event that occurred in a US city, and we've seen this in response to political events such as the election in 2016. We've seen it with respect to sporting events or sports victories. This was actually after a Super Bowl win. And so you can see in this particular city, there was a spike in news demand, and it actually increased subscriptions substantially. However, after the demand was over, there was a drop in the actual number of sales. And so what we've learned through these activities is how you can anticipate this drop and what to do about it. And the short story is that what happens in these spikes is you're actually converting people that are already in your sales pipeline. You're accelerating their conversion. And so you need to actually refill that conversion pipeline. And there are things you can do with that. And there's also pricing implications for this. You should really not be offering dramatic price incentives during this particular time. You should reserve those for afterwards. So that's the first core point. And again, happy to answer any questions you may have on that. But the second primary point of this session was to just really briefly share the science a little bit behind price discrimination or pricing strategy. And so there are a lot of numbers on this slide, and I won't go into detail other than to point out that if we were to compare a targeted pricing or a more strategic pricing strategy to essentially an across-the-board strategy and we're focusing on renewal pricing in this example, that the targeted pricing will usually yield a tremendous amount of more incremental revenue from a price rise or price increase at renewal. So in this example here, about almost a 40% additional revenue from a price action that's applied in a more scientific way. And so how do we do that? So the key point is to understand what's your price elasticity look like among your subscribers. And this is a distribution of price elasticity for one of our clients. And you can see that there's a pretty significant range of price sensitivity across your subscriber base. And there are people on the far left that have very low price sensitivity and people on the far right that have very high. And as you often will hear, there's the 80-20 rule is in effect that 80% of your price related stops will come from these people that are the bottom 20% of your subscriber price elasticity distribution. So the solution is not to give everybody the same price increase, which would be represented by the flat line, but perhaps to maybe not give people on the more sensitive end a price increase, or maybe give them a lesser increase and then give the people on the top end a slightly higher increase. And there's different ways to do this. The second concept is to A/B test these. And A/B testing is something we do for hundreds of our clients. And in this example here, just to share what this looks like, is we actually asked a client to have a holdout group. So when they had their annual increase, which they did as what we call business as usual, was everyone received a 5% increase. We just asked them to take out a statistically representative sample. And when we compared the performance of the target group that received the increase to the control group or the holdout group, what we see is that 5% price increase caused an incremental 9% stops among subscribers in their first year. However, that same increase had a far smaller increase, less than 0.5% stop rate for people that are in their fifth or greater year of subscription. So just understanding tenure alone gives you a tremendous amount of insight into who's most likely to stop following an increase. The other concept is acquisition. You can actually use similar types of analysis. If you predict the ultimate lifetime of a subscriber, what we find is that when you increase or lower price, you're essentially getting a different type of subscriber on average. As you'd expect, a lower price offer will bring in people that are more sensitive to price and also much more likely to churn for a variety of reasons. And so when we look at what's the optimal price, we can use a lifetime value framework. And in this example here, we've actually showed that this particular client could increase their total expected lifetime value by dropping their acquisition price slightly. And this is really my getting close to the end here. We know that pricing strategy can be somewhat of a sensitive topic. And so there's different ways to apply pricing strategy. You don't have to do it at the customer level. You can actually do it at different degrees of aggregation by product or by customer segment or by customer itself. And we can actually measure the trade-offs in pricing yield versus segmentation granularity. And my last slide is really this, that in this era of switching platforms from print to digital, pricing strategy can actually help you extend the run rate of your print product revenue and give you time to make a true digital transformation of your business, if that's ultimately where you're heading. In this example, you can see we've actually kept revenue flat by raising the average rate and mitigating the loss of print subscriptions. So that in a nutshell, just these two slides are just about us. We work with many customers in the publishing industry, and there's about 45 of us, and most of us are economists and data scientists. And I would be happy to share this and other reports with you anytime. So please feel free to contact me, and I'll be happy to return these documents.
Well, thanks, Matt. That's fabulous. And already questions are coming in, so that's something that you may want to take a look at. Meanwhile, we want to ask from the Atlantic, why don't we go ahead and start with your presentation? We don't have any slides for you, but...
Yeah, I got no slides. You know, we've lost all access to PowerPoint and Google Slides, part of the pandemic of being in New York City. So you'll just have to bear with me blabbing on for a little bit. I'll give a little bit of context of kind of where we've been and where we are now overall from a subscription standpoint. I'll talk a bit about price testing and optimization, but mostly hope to just be able to hear from y'all and have a fun and lively conversation. So we had a fairly traditional subscription model up until September of 2019. We offered mostly print and digital, print only, and we had a sort of a modest digital only package where before we launched a meter on the site, it got you access to the PDF and other small perks. But we knew that we had to shift our strategy to get ahead of what no one had any idea was going to happen in the advertising market. And so we ended up pushing back our launch a little bit because some of the, and I'm sure this is just as true across the world as it is in the US, but some of our legacy print systems we felt weren't going to allow us to move as quickly. And so we spent a period of time kind of working with and around our legacy systems and partners, used Stripe as our credit card processing, and tried to kind of modernize our technology infrastructure as much as possible. And so when we launched in September, we launched with a note from our editor-in-chief and kind of a big hurrah on the website. And it was incredible. We blew all of our expectations out of the water. We had developed a fairly sophisticated, complicated model projecting, paywall stops, conversion rate by nudge, which is, sometimes called the growler, but it's the thing usually at the bottom of the screen that tells people how many articles they have left. And, by multiple digits, we exceeded our expectations, and then fairly quickly went into more of a business as usual state, still exceeding our kind of modeled expectations, probably by double on a monthly basis, but sort of we're seeing a leveling out in terms of our acquisition on the site. And then in March, everything exploded in the world. Everything also exploded in our business, and on the subscription side, it was explosive growth in a really powerful way. Nothing really changed about our business model or strategy. We got a lot more aggressive about email marketing. We wanted to make sure that everyone was aware that we were putting a good amount of journalism outside of the meter. So that was available for free. And so our editor-in-chief had been sending emails every couple of weeks, letting folks know about that. But we reported on this publicly, so I can say it. So we had about 37,000 subscribers in March, and certainly our single best month since September. And pre-September, you can't really compare to it because it was a completely different business model. The way that I kind of think about why that is happening is in addition to so many people working from home and being totally freaked out like all of us about the fate of the world, it's, I just sort of say it's the journalism stupid. Our journalists kind of rose to the moment in a way that had us all in awe. We had major features from a Brit, Ed Yong, our science writer. We had lots of really strong political argument and reporting. We actually started a project that has become open source called the COVID Tracking Project, which has been sort of a de facto reference point for a lot of broader tracking efforts. And so it was pretty extraordinary, the support that we saw. What's been equally extraordinary is that those numbers have mostly stayed consistent from a subscription standpoint, even though traffic, we're still kind of beating our record month every month. But in April and May, the traffic hasn't been quite as high as it was in March and sort of this explosive moment. But our subscriptions have stayed really, really high. And so we're seeing the same numbers that Martha and Matt were presenting. We've tripled our daily paid media spend on Facebook and Instagram, Twitter, Google. And so the big question is, and this is where I'll transition a bit to pricing, is how long will the demand that we're seeing continue, and how will all of these kind of COVID era, post-COVID era subscribers behave? Will they be as loyal as not loyal? We don't really know because we've stuck to annual pricing for now. So we don't have a monthly option. We haven't launched significant discounting like Matt was saying. We feel like as long as we're seeing this amount of demand with an annual package, why potentially cannibalize that when we know that annual is going to renew at such a higher rate? Most of these folks are in auto renew. I don't know if anyone on this webinar is familiar, but there's something called GDPR. I can't see if anyone's laughing, but that's obviously a joke. We're all very familiar with it. There's also the California auto renews. So that has made that auto renew picture a little bit complicated. Usually that's the best predictor that someone's gonna renew. But we're gonna stay steady with annual for now, and kind of pay attention to demand. In terms of how we got to the kind of pricing that we currently have, it's for the most part a doubling of, at least at the introductory level, at the entry level for our digital only, of what we had been offering. So we had been at 25, we're now at 50. Print and digital had been at 35, it's now at 60. And the way that we got there was we did a Van Westendorp study. We worked with Piano's consulting arm to perform that. And we asked a little bit about kind of features and which features people would have interest in, but it was mostly looking at how do we think about annual and monthly pricing. Some of what we got back from that qualitative research kind of hewed to our expectations. Some of it was pretty off. I think for the most part, the digital and print and digital, so we're about 60-40 folks who are doing digital only versus who also have print in their bundle. The uptake of premium was well below what we saw from a survey standpoint. So we thought that a lot more folks were going to be paying for our $100 premium product than ended up paying for it. That said, we knew that the demand for that was going to be low, and we wanted to keep it anyway, because if that meant that we would increase demand for our print and digital, which was a higher price product, and actually even more profitable, and made the digital package more appealing, then we were comfortable with a lack of kind of significant adoption on the premium side. And like I was saying, we have a ton of legacy subscribers, before launching our metered paywall. And so one of our biggest goals is how we call it the path to price parity, which is a nice alliteration and it's a mouthful to say. But so getting to price parity, having our legacy subscribers be paying the same amount as our new subscribers, kind of post paywall. We worked with Matt and the Mather team to do a dynamic pricing model. I will say that Matt's one of his later slides that was showing that you could do it by cohorts and segments and not doing it down to the subscriber. I think the first file that we got had like thousands of different price points, and we're a small team and we were like, this is great, guys, but I don't think we'll quite be able to accommodate that many prices, especially working in our kind of legacy system. So we simplified it. We looked at tiers of individuals, what they're paying, tenure for how long they've been with us, whether they're in auto renew or not, and a lot of those other variables. And the test has been really successful. We're continuing to go with the dynamic pricing model to try to get everyone up to our new prices. We know the demand curve is not going to last forever. And so I think the question is a little bit more when, not if. We'll launch monthly and kind of trials and do lots of tests there to continue to be able to grab demand. But for the moment, we're really happy. I mean, honestly, we're bowled over by the support that we're seeing and just the demand for people paying for journalism. And so I would say overall, we're happy with our pricing strategy. And then obviously over time, over the next 3 to 5 years, we don't necessarily want to stay at the same price. And so there's going to be a lot of testing. We'll test, what it might look like for different bundles to be the same price, different prices, et cetera. And so there's a ton of A/B and multivariate testing to do. But so far, we feel like our business model and strategy has been working.
Thanks, Sam. Much appreciated. We already have some questions coming in for you. And I guess one question from Steve Yeager is very appropriate at this point, and that is, what is your annual subscription rate?
So annual print and digital is $60. Digital only is $50. And then our premium, which has ad free and a couple of other perks, is $100.
Sam, how did you come to that price in the first place? Was that based around, were you using print as a reference for that originally? Or was it something, I mean, obviously you tested it a lot, but you had to start somewhere. Where did the starting point come from?
Yeah, I mean, I think we knew that when we launched our metered paywall, we didn't want to keep prices the same. We also knew that we didn't want to sort of do a race to the bottom and just try to get as many subscribers as possible. I think that the magazine media business, for understandable reasons, has been, I guess it depends on your niche or sector, but somewhat of an arbitrage game from an advertising standpoint of getting lots of low cost subscribers and then selling them to advertisers at a higher clip. We all know and have seen what's been happening in the advertising industry. And so from the very beginning, we sort of had a spectrum of, on one hand, pure scale, on the other hand, pure kind of average order value or lifetime value per subscriber. So if we wanted to go for pure average order value, and didn't really care about our total number of subscribers, we might have launched with something like $100, but that would have been a quadrupling of our entry-level product. We also certainly didn't want to reduce price, because even though that would have gotten us, hundreds of thousands more subscribers probably, we know from lots of data. One of the nice things about being a little bit later to the game is that we can learn from everyone else's opportunities for learning. I won't call them mistakes. And so that was kind of our strategic context, that we wanted to optimize for revenue and subscribers kind of equally. And then through our Van Westendorp study, what we saw, so Van Westendorp kind of creates cliffs of pricing where you can offer different pricing for different packages. and then you see what seems to be a psychological barrier at different levels. And so for us, we really saw the $50 price point. That was a huge cliff in terms of expected demand. And so we felt, doubling our original prices, but we didn't feel comfortable enough ignoring the data to the degree that we thought could really kill our demand, kill in a good way. And so we hewed pretty closely to the Van Westendorp. We went a little bit above for print and digital. The model mostly had demand be equivalent, of maybe a little bit down if we priced above, but there are costs of delivery, and we also wanted to signify the value of our print product. And so we just went $10 above for print. And the other thing is we eliminated print only. So we silently converted, upgraded all of our print, not silently, we let them know, but on the back end, we converted all of our print only subscribers to print and digital, and then stopped offering that on the website. So we knew that we didn't want to have a print only product anymore. I will say, because I know that this was potentially going to be a question that I just remembered, the whole question of pricing monthly versus annual. My philosophy with qualitative data is that it's good to give you signals, but it should only be directional. It shouldn't be too prescriptive in terms of your strategy. And so one of the really interesting things that we saw from the Van Westendorp was that when it came to monthly price, so people could say, do you want to pay for the Atlantic annually on a monthly basis? And so of those who selected monthly, and then of those who scored a 4 or 5 who said that they would be likely to pay. So we only looked at the folks who said that they would be likely to pay, not the folks who said that they might or probably wouldn't be likely to pay. When you converted when you looked at the annual folks, there was a massive price disparity. So the monthly folks said like, oh yeah, $10 a month sounds totally reasonable. And then the annual folks said, no way we're paying more than $50 a year. And some quick math, as I'm sure many people are doing with their kids at home during homeschooling, would reveal that there's a significant disparity between $50 a year and $120 a year. And so even as we think about launching a monthly product, we're mostly going to ignore the idea that folks said that they would be super comfortable paying $10 a year, because our feeling was that was just their gut kind of reference point for Netflix and Hulu and other entertainment that they're paying for, but that we should take more seriously how they see the annualized cost of a subscription to the Atlantic, and use that as more of a baseline for how we might think about monthly pricing.
Well, that might be a really good segue to a question that came in before our webinar started from Nat Geo. It's all about pricing and models. So this person would like to know, is there research or testing analysis that explores pricing models in relationship to content type? Now, both of you can answer that from both of your perspectives, but what this person means is print versus perhaps the Netflix model or Spotify model. What models have you chosen, Sam? And Matt, what's the science behind choosing the model for pricing?
So I think it's sort of yes and no, or both and, or whichever improv metaphor we want to use. In a certain sense, what we found in all of our qualitative research is that we can't really avoid the perception of the Atlantic as a magazine. Especially, we knew that a lot of our initial subscribers were going to be folks who had known about the Atlantic for a while, probably skewed a little bit more in the 40, 50 and above age demographic. And so those are folks who grew up with print magazines and who have a mental model for what a magazine should cost. And even looking at, so we don't charge as much as the New Yorker, the New Yorker being at, I think now 48 times a year versus us being at 10 times a year. In a perfect world, we would not have to consider print frequency and print, the print magazine in terms of how we price. we are deep believers in print as a model, and we love the print magazine. We think that it provides a great opportunity for people to engage with our journalism in a really tactile way. So we're very pro print overall, but we also knew that it would also be great to charge a Netflix rate, or to charge out of the gates what the New York Times was charging. But what we didn't want to do was underestimate people's psychology and their mental models for what you should pay for a 10 times a year magazine. And I think we were largely right. I still stand behind that thinking. And so hopefully over time, as what we do is more about kind of magazine journalism and not only tethered to a pricing model that's tied to a 10 times a year print magazine, we'll be able to increase our prices, and we're definitely going to test the levels of elasticity and inelasticity, not from a renewal standpoint, but from an acquisition standpoint, where we would start to depart from the 10 times a year print magazine mental model. But certainly, for our first 6 to 12 months of launch, we wanted to be realists and know that folks are thinking, are doing the mental math to think about a 10 times a year magazine. That said, from an editorial standpoint, we just think of ourselves as One Atlantic. Obviously, the print magazine has a longer runway. There's more care and editing that by nature has to go into each article. But we're also publishing, we think of ourselves as publishing magazine quality journalism on the site every single day. And we also are publishing lots of digital only features, like what I was talking about from Ed Yong, and stories from Jim Hamblin, Ann Applebaum, who has written print features for us. And so from an overall business model standpoint, we just think of ourselves as kind of a magazine journalism brand and publishing magazine quality stories. But from a pricing standpoint, I think it's hard to avoid the connection to print in people's psychology.
Let me add a quick thought on that. So our experience is that in acquisition pricing, that you really don't have as much knowledge about the customer, obviously. And so that really it's less about targeting at acquisition. It's more about managing kind of the flow of subscriber starts. And then once you have them in your database and you can observe their behavior, you can then have a lot more sophistication around their expected price elasticity. One of the questions that came in was a brand new, a long-term print product that is initiating a digital subscription for the first time. What's the right strategy for that? And what we recommend is that you don't necessarily, the first subscribers that you'll get digitally are likely going to be your most engaged and most fanatical kind of readers. And so price is not going to be the motivation for that particular segment. We find people subscribe typically for four reasons, and this has been verified in other research. There's certainly the cost component, so how much is the price, but there's the community aspect of it, there's the content, and then there's the cause of journalism. So people will be motivated for different reasons. Only one of those is typically price. So we recommend starting with a fairly high price that has some relation to your print product, usually not as much, because there's a perception that I'm not getting a physical product. And then I would also, just to the point on Netflix, I think there's people's minds, there's a pretty significant difference in their perception between a product like The Atlantic and Netflix. So I don't feel like you have to, feel like you're competing with Netflix in a pricing context.
Yeah, totally agree.
Thanks to Sam and Matt very much for your presentations, and please stand by for the questions.
Great.
Top voted question: what percentage of your new clients, I guess this is a question for you, Sam, what percentage of your new clients subscribe without hitting the paywall? Did that percentage change during the pandemic?
Oh, that's a great question. I can't see everyone, but I'll just trust that if I start the data that I start to give, that y'all won't tweet it. So I would ask you not to. I know that we're not in Chatham House rules here, but
yeah, we will be for the next 2 minutes while you talk. We will be.
Great, thank you. Yeah, so in any given month, we call it our gateway. So the true kind of paywall, we'll convert probably at least a quarter of our subscribers. And our nudges are also, I think, a similar amount. I don't have all the data in front of me right now. But we also see like repeat gateway hitting is a really important indicator of subscription propensity. Even just like people subscribing in a single day, reading 2 articles in a single session is most correlated with subscribing in a single day. And so, our North Star is habit and getting people back to the site multiple days in a 30-day period. Because it means that they're engaging with our journalism. It also means that they'll be more likely to hit the gateway or to hit the paywall. But we've been surprised. I mean, our nav bar is directly attributable for about 30%, anywhere between 25 and 35%. So the nav bar is sort of, in any given month, could be equivalent to the true paywall, the gateway itself, in direct conversions.
Wow, that's amazing. So there's people.
Yeah, to me, that sort of signals the amount of folks who are subscribing out of support, out of the cause of journalism, where, if they're not being forced to subscribe, so to speak, and they're just compelled emotionally, then they're probably going to hit the subscribe button in the nav bar.
I don't know whether you or Matt have any data on this. It just occurs to me. Do you know whether there's a proportion of people who arrive on the site wanting immediately to subscribe? In other words, they know before they get there that that's what they're going to do, and they just want the shortest route possible to sign up. They've made their decision offline, and they're coming back to the site to do that.
Yeah, I mean, we definitely have a percentage of folks who convert on our first nudge, for example, who come to the homepage and convert. It's not as high of a percentage. Like generally, the closer you get to the gateway, so like nudges 4 and 5, the 4th and 5th article that you read in the meter convert a lot better than nudges 1 and 2. So there's a correlation to repeat usage and propensity to subscribe. But we certainly see folks come and subscribe either their first session, first day. The thing that's hard to know is because of the cookie world that we live in, how many folks are actually have come 5 times, but then just like bought a new iPhone or using a different device and subscribed. And so we don't put too much stock in new visitors or like first time subscribers. We more try to look at the patterns of the relationship between kind of habit, repeat usage, and subscription, because we also think that that's the more sustainable way to go about our strategy.
Yeah, sure.
I'll just add a quick spark on there. We find that over half of the subscriptions in a typical website come from things other than the paywall. That there's email, newsletter click-throughs, there's email, offers that but I will say this, that the other interesting fact is that most subscribers hit the paywall multiple times before subscribing, often as many as 7 to 10 times. So just because they hit it and they bounce off, it's not necessarily a bad thing.
It's funny you say that, Matt, because I think we found that like 12 is a drop-off point where if someone hits the paywall 12 times and they're probably not going to subscribe. But from about 3 to 11, it goes. So first paywall, this is my slide. This is conversion rate. So first paywall hit is maybe here. This is 0. Second is here, and then third is like up there, and then it sort of stays there. And then once you get to 12 or 13 gateway or paywall hits, then it starts to drop off because those folks probably either they're bots or they're not as likely to subscribe.
Matt, I have a question for you from Rory Brown, who's asking whether you've done any work on price elasticity for corporate B2B accounts rather than individual subscriptions, and interested to know whether you see the same trends there.
We have, yeah. Generally, B2B subscriptions are even less price elastic than consumers or B2C subscriptions. There are some what we call firmographic information, which is the parallel to demographic information. You can look at firm size, industry, vertical. You can also look at there's a lot of times there's corporate, site licenses. So very much able to, you can do some price, customer segmentation and pricing, strategies for B2B. Absolutely.
I have a question here from Ashish Thomas, one of our members in an Asian market, based partly in Singapore, partly in the Philippines. He's asking, in a market, and this is maybe a hypothetical question for you both to think about using your experience, in a market where there are no subscribers or players who have no digital or negligible digital subscription play, which is largely the case in Asia where there's very little print reference to base it on, how would you benchmark price points for a new subscription service? I mean, just kind of circling back to what we talked about earlier.
Matt, I'll let you take that one first.
So of course, going back to our earlier discussion around your own print product is probably the most significant benchmark. I think there are other, global brands that people are mostly aware of these days. So you'll see often the New York Times or the Financial Times or just the Economist magazine. Generally, there's a sense of what people are aware that are likely to subscribe to online products. They have some sense of what that looks like. And again, what I mentioned earlier is that, getting the first price out of the gate I would err on the side of higher price because it's always easier to go down than it is to go up. So I would, and also the people that you're most likely to convert right away are your most engaged readers. So typically start somewhere close to your print product and then offer discounted offers or incentives as you start to plateau your new subscriptions.
I'm going to step back a little bit from pricing and ask a couple of questions that have come up in everything we've done so far around monetization and different business models. And the first one is around the balance between advertising and digital subscriptions, because I think it would be interesting, Sam, to get your view on this. Is it the case that with a digital subscriptions approach, such as the one that you guys have implemented recently, that you have to give up on your digital advertising? Can you create a balance between the two in your revenue model?
No. I would say, if anything, having more digital subscribers will help from an advertising standpoint because it gives advertisers an opportunity to engage with subscribers. I mean, one of the things that we've been seeing sort of as incoming requests and interest from brands is they're aware that media and journalism is kind of moving towards a subscription first world. And so they've actually been inquiring more about different ways that they could possibly sponsor exclusive content or a really nice experience for our subscribers. And so there are kind of two levels. One is bespoke partnerships that we've been talking about with advertisers that allow them to reach our subscribers who are, our most engaged folks. And then the other is looking at what's typically called yield optimization. And that has to do a little bit more with programmatic revenue, but figuring out how we kind of optimize our page so that we're not just balancing, but actually optimizing the amount of revenue that we're making between advertising and consumer revenue. So we certainly don't see the two in conflict on our end. That's partially, we have a metered paywall. So there's not a question of kind of behind and in front of the paywall. And given that we're a larger site with, tens of millions of uniques every month, we have the majority of our visitors are one and done or, coming not more than two or three times. And so we're still able to reach the vast majority of our audience from a page view and unique visitor standpoint within the first 3 or 4 articles that we're reading. So we certainly saw some programmatic advertising loss because, folks who are now getting cut off at the 5th article maybe would have read 30, 40 articles. So there's going to be some page view loss there from a revenue standpoint, but the profitability of subscribers from kind of more of a holistic view definitely more than makes up for that.
Yeah, I would add, we do a lot of those types of calculations for clients, and what we've, to Sam's exact point, that a subscriber is a stream of revenue that we can forecast. And so what we do find is there's an optimal balance between how much content you're putting behind a premium wall or a paywall, and we can help you determine that. Generally, as the CPMs of ads have declined over the past few years, that's argued in favor of more subscriptions and tighter paywalls, and that's certainly what we're seeing in the market.
A good question here from AJ Mishra. Thank you, AJ, for this. The flip side of price, of course, is acquisition cost. What's a good benchmark for acquisition cost? How do you think of that? I mean, you talked earlier, Matt, you talked about lifetime value. I guess it's probably a metric that you use as well, Sam. What do you think about in terms of benchmark acquisition cost for subscribers?
Yeah, so we're early into our new pricing strategy and we're not even at a year-long renewal. We have our renewal moment is going to be September 5th of this year. So kind of on faith and knowing benchmarks, we're doing a 3-year. So we take our average order value across all 3 bundles, and then take kind of a blended. We'll test out between kind of 75% and 85% retention as an assumption. Auto renew digital subscribers are going to be much more in the 80s and 90s. Print subscribers are not going to be quite as high. And so right now we're a CAC, a cost per acquired customer. We're kind of doing 3-year with, and I forget where it is in the 75 to 85% retention rate, but that'll get more sophisticated over time. Our data science team is building a more nuanced lifetime value model of different packages, geo, et cetera. But we were comfortable launching with a more crude kind of 3-year LTV with some basic retention assumptions in there.
And are you going to announce volumes at any point? Have you done that so far? I couldn't see anything.
Announce what?
Number of digital subscribers that you've got.
We may.
You might. Good.
We're audited by the Alliance for Audited Media, so folks can generally see, whenever those reports come out, you can see our subscriber file. So we won't really be able to hide it for long, but I think the next AAM statement wraps in July. So we may announce then, or just let the statement speak for itself.
I think you'd be in good company if you were. There are very few magazine brands that have done that yet, and it would be really good to be the kind of leader in there. I want to ask a question from Lucy Kuhn, who's a frequent contributor to Fit Things, and of course very well known in this world. She's asking, you say that the caliber of journalism was decisive for the Atlantic's current success, but how did you build the link between the business and the editorial sides when you implemented the paywall? Did you develop principles and guidelines to help those in the newsroom focus their work? So how did you build the Washington Post? I know I've talked a lot about the connection between the two. Have you done something similar?
Yeah, I would say our newsroom actually developed sort of its own principles. I mean, in one sense, I could be glib or flippant and say the principles were kind of identified 163 years ago when we started, and that is true. I mean, there are certain things, being of no party or click. There was a quote where we said that every print issue would contain at least one article that was to be the plowshare that would break up the old fields. And so there is a lot just in our editorial DNA itself, but our newsroom kind of identified how they wanted to approach this such a significant moment, and that one of the really happy things that we find is that our data and our editorial ambitions are totally supportive of one another. So we don't have one of those classical, almost like caricature situations where the growth team is saying, we got to do more cat videos. And then the editorial team is saying, what are you talking about? In a subscription-based model for a brand like the Atlantic, what we found actually 100% of the time is that the stories that we, most wish that people would say, like, yes, I'm going to pay to get stories like these, are the stories that people actually convert on and pay for. So we certainly have, we talk a lot. Our data science team shares lots of data, but I would say that our newsroom itself sort of has identified the types of stories that it thinks are the most Atlantic-y, as we say, and the most valuable to readers.
Fantastic. It's great to hear. We're running out of time, so I'm just going to do 2 questions to close with. We've managed to get all the way through without asking a specific question about COVID and coronavirus, but I'm going to do it now. Have you had to be, this question for Sam, have you had to be cautious about how you treat COVID and coronavirus related content in terms of both pricing, putting offers around that, and making it explicitly paid or not paid? I mean, is that something that's featured in your decision making?
So our, again, the newsroom from just an ethical and moral standpoint wanted to make sure that, any story that really felt in the public interest could be non-metered. And, we supported that from a business standpoint. And so even today on the site, the newsroom is continuing to put stories each day outside of the meter. The thing that we've done, or I should say haven't done from a marketing standpoint, is I just personally felt sort of weird around capitalizing on coronavirus specifically as like a marketing platform. And so I've wanted our marketing team to stay away from mentioning it too explicitly. We do have on all of the stories that aren't metered, so that don't count towards your monthly kind of paywall allowance, if you will. We have a message at the bottom that's dismissible that says, this is part of, you're reading the Atlantic's free coronavirus coverage. So we at least wanted to make sure that people were aware and had the opportunity to support us. But we've generally found that doing that has created so much goodwill. People have come out and really wanted to support us. And again, like I was saying earlier, I feel very lucky, but we almost never find tension between any data that we're seeing and sort of what the newsroom feels is the appropriate thing to do. So, we would have made that decision anyway to put stuff outside the paywall or to not meter it. But it's also a really happy coincidence that all of the signs point towards that being really smart from a support standpoint too.
Fantastic. One last question for Matt from an anonymous person. Did I understand correctly from Matt's presentation that we should charge more for our most loyal and tenured subscribers, but shouldn't we give our most loyal and tenured subscribers the best deal?
So this is a great question. It's very counterintuitive, and I was waiting for this to come up. So thank you for the anonymous person that submitted it. So that does sound counterintuitive in a lot of ways. However, what we find is that the most price sensitive a customer will ever be is right when he's experimenting with your product. So your product's not a part of his daily routine or his habit. And so there's also some uncertainty as to what the value proposition is for those new readers. So normally that's why we say if you're starting a digital product, start with a higher price, because those people are usually the ones that have invested in your product and they have that relationship. Then as you acquire new subscribers, you reach a plateau, acquire people that are on the fence, and usually you want to remove price as a barrier for that entry. And so the goal is to give people somewhat of a price, but as you trade a price, oftentimes what we ask for is a commitment in terms of term. So Sam says, as he's rightly done, started with annual subscriptions, because when you drop the price, you increase their churn risk. So you've seen like big brands like the New York Times, they're now offering quite aggressive, $1 a week type of offers. And there's an understanding that they will move to full price. But yeah, really the ones that tenure is one variable. Certainly what we're trying to do is match the price to the value proposition that person's receiving from your product.
Fantastic. We're going to wrap up there. Martha, any last thoughts before we do?
No, just thank you to our wonderful speakers and to FIP for putting on this really useful webinar.
Thank you very much. Thank you very much to Sam and to Martha and to Matt. Thank you for your contributions. Thank you to all of you for watching. You will be able to see a recording of this webinar on our YouTube channel, which you can find at youtube.com/fipworld. That'll be up in the next few days. You can also follow us on Twitter at FipWorld, and I'm at FipCEO. If you want to also learn the latest from FIP and find out when we're doing more of these webinars and more of our content, then do subscribe to our newsletter, which you can find on the website, fip.com. We'll be back on Tuesday with a session on e-commerce. we've got representatives from Tipsa, leading e-commerce technology company, who are going to tell us about how InStyle have transformed their business through e-commerce revenues, a very interesting other form of monetization. Apologies to all those of you that we weren't able to get to in terms of questions. We will try to answer some of those as best we can on email and in the post-event report. You will get a post-event email tomorrow with details of everything that we talked about today. But in the meantime, thank you very much for joining. Thank you and good afternoon.
Thanks so much.
Thank you very much.
Thank
Bye-bye.
you.